Is the housing market in trouble? The biggest problem I see with the housing market isn't what's been on the news. In fact, it's one key thing that hasn't been mentioned at all. But first, let's talk about leading indicators, including Airbnb. Now let's take a look at some leading indicators for the housing market. There are quite a few of these, and some of these are traditional, some that we're going to talk about are not. Now let's talk about the most glaring one, and that's affordability because of the mortgage rates. I'm sure you've heard the stories by now where somebody from the 1980s was telling you, hey, interest rates were at 20% or 80%. Well, not really that high, but they were high. And they're saying, and we can afford houses. Now, they're missing a big piece to this. Prices of homes weren't as high as they are now. Let's take a look at affordability when it comes to home prices for 2019. We can take the average price of a home in 2019 with the average interest rate, and this is what your payment would be like. Now, if we take a look at home prices today in 2023, here's the average, and let's take the rate at where it's at right now approximately. And this is what your payment is going to be. There is a massive difference. And the thing that we're not even including here are utilities. When you buy a home, you have other expenses. It's not just having the home payment, mortgage, principal, interest, property taxes. Now, affordability wouldn't matter as much if pay had gone up just as much as home prices. But because of inflation, we've had a big challenge with all consumer goods and, of course, real estate. Let's check out 2019 to 2023, just showing you the difference in growth from your pay and the difference in growth to home prices, which leads to another indicator, and that's jobs. If you don't have a job that pays well, how can you afford to buy a home in this market? But how are we doing with unemployment? Because in this current market, it feels like there are a lot of people suffering through what I'm hearing as a silent recession. And I know that there are people struggling out there, but the good thing for now, at least for now, even though the Fed has indicated that they've wanted to destroy the real estate market because prices are too high, unemployment remains significantly low if you look at the past years. Now, if unemployment gets crazier, yes, that is one way that there will be more inventory of homes. Why? Because people can't afford to pay anymore. Will they go into foreclosure though? Well, that's a challenge because most homes, as you can see, have a lot of equity. And if they have a lot of equity, if they sell, they're still going to get money back. But let's talk about inventory. A lot of people on the media and economists are saying that the inventory is significantly low. In fact, here is the norm. You can take a look at over the years what the normal amount of inventory should be. And if we take a look at the inventory back in 2009-ish, you can see that that was the lowest point of inventory year over year. And fast forward to where we are right now, we're not too far away. You see, the supply is very close to where we were before. So what's holding it up? In fact, the demand for supply in most parts of the United States has remained higher than the supply. Now, there are areas like Austin, Texas, that have been hit pretty hard just over the last year. And those areas saw an influx of people through COVID moving out of states like California and New York. And now you're seeing the demand go down significantly. Now, here's where it can get challenging and where some people get a little bit confused. If you go back to when the Fed was starting to raise the rates, one of the things they kept on mentioning is the correction of the real estate market. The problem is that it actually never happened. They expected prices to go down significantly because that was one of the reasons inflation was being driven up. Instead, we saw everything else go up. Lumber went up in price. The cost of building went up significantly, which caused new construction to slow down the amount of homes they were building. Most of what was selling just over the last 2 years were resale. But now that's changing up. In some states, we're seeing that a lot of property that's being sold is new construction. Just take a look at California here, where most people think it's a dying state. It's actually holding up pretty well. If we continue on inventory, if it wasn't for new construction and rates, mortgage rates, being so high, we would actually be worse than we are. Because most people who either owned a home or bought a home during this COVID period where the interest rates for mortgages were significantly low, they either refinanced or bought a home with a great rate. Those are the people that are sitting tight. They're not putting their homes on the market. They still have a job, they have income coming in, and there's no reason they're going to put their home on the market for sale if they're going to move to something else that's not only more expensive, but at a much higher interest rate for their mortgage. So where can more inventory come from? Because if we can identify where more of this inventory can come from rapidly, that will crash the market. Where could it be? Could it be from Airbnb, like this guy says? Could it be like Rich Dad Poor Dad is saying? Are they right about Airbnb? Now, here is where we go regional. Yes, areas like Austin and Phoenix and some areas are suffering from investors jumping into Airbnb, but other areas are doing well. Now, what happens if an influx of homes come in for sale from investors that said, hey, you know what, I just can't rent my home anymore? Most of them still have equity. In fact, you've seen what's happening in New York where a lot of people are like, I can't Airbnb this thing anymore. Let's go a long-term rental instead, more traditional. So you see, Airbnb isn't going to crash real estate in the United States. In fact, it's too early to tell. What you're seeing is some influencers, some people who want to make a name for themselves are identifying possible opportunities of failure just to be early on and say, hey, didn't I tell you back then? Didn't I say World War III was going to crash the real estate market? Look, it's the world we live in right now. People remember those people that were early on and guessed it right. They won't remember all of the other times that these people called it wrong. Now let's take a look at unemployment and debt. It's a real problem. And if we continue on this route where more people will be unemployed and have a lot more debt, then yes, this will be a serious problem for housing. But let's take a look at where foreclosures are right now. And let's take a look at where foreclosures have been over the last few years. This will give you a better understanding of what the norm is, if you can call it that. Now you see the challenges that were not there yet. A lot of people calling the crash. This isn't going to happen overnight. And the reason that foreclosures are remaining low is because most people have equity. So if they want to sell their home, they're still going to get a lot of money back and still be able to pay the bank what they owe for the late payments. That's the reality of foreclosures. Now, there are a lot of these leading indicators that can take us into a market crashing for housing quickly. But as I'm showing you, we're not there yet with any of these. Now, in areas like Austin, if you bought a home just over the last year, then you're probably looking at being in trouble if you have to sell the home. This is a concerning thing because where will we be 2 years from now for everyone who's buying a home right now? Now, there are some that say rents can help. They can help you better understand where the real estate market is heading if you pay attention to rents. If rents are high, more people will want to buy as long as owning a home with the tax benefits and everything else is slightly less or equal to rent. When rent is significantly less, more people will want to rent than own a home, which typically means prices for owning a home come down because it's not as desirable. In some cases, some people have even used equations to try to figure out the correlation between housing and renting. I mean, earlier this year, we even saw rents being higher than owning a home. But all of this will depend on the economy and the mortgage rates. And if the rates fall too fast, There will be an influx of people buying homes, which means for a little bit, there'll be even less inventory until the sellers said, hey, you know what? The interest rates are actually low enough for me to sell my home and jump into something else because it makes a lot of sense. Then one of two things will happen. A lot of sellers will jump into the market and you'll have a lot more properties for sale than the demand. Then the demand will be equal to the supply and we'll still see prices super high. The point is, dropping the rate fast is a problem either way. This is why we need to keep an eye on where is the inventory coming from, because that matters. And if I can tell you one thing is that it's not coming from Airbnb. It will not crash the US market. So what's the one thing that people aren't talking about enough that will crash this market? Inflation. It's the biggest problem we have. And if the government keeps on printing more and more money, prices of everything will continue to go up more. See, that's the original problem. We've never printed this much money before. What else did we expect but prices to go up on everything, consumer goods and real estate? Now the Fed is saying, well, let's get back to that 2% for inflation. But in an effort to do that, they're going to raise unemployment. They were hoping to crash the real estate market with mortgage rates going up significantly. The one thing they didn't anticipate was sellers holding on to mortgages that are significantly lower than ever before. So if inflation comes down too fast, there's going to be a problem. And if it continues to go up even more, there will be a big problem. We're sitting in an interesting place right now. And this is why you're having lots of people say this will crash the market. We're not in a housing crisis. The point is, nobody knows what's happening, not even the government. So be smart about this. Look at the facts, look at all of the data that you can, and know that right now we don't have enough data to say that the market is going to crash. But keep an eye on it. I'm Tristan. Subscribe, follow. We'll keep on talking about this. Inflation is the biggest problem. And if you don't agree with me, then you're not paying attention.